Hello, welcome back. Here is Ali Talibi, and this is our module 7. In this module, we are going to talk about stocks and stock valuation, one of the most popular topics in the world of finance and investment. In the first lesson, I'm going just to introduce you to the world of stock, and so I will tell you what is stock, and we'll distinguish between the common and preferred stock. We had this conversation regarding the primary and secondary markets. I'm just going to refer to those markets since the major markets in which the stocks are traded are secondary markets, and secondary markets are based on primary markets, so I'm going just to talk about them. And at the end of this lesson, I'm just going to show you a screenshot from Yahoo Finance, and I'm going to talk about some common jargons in this market, such as ask and bid, beta, price earnings ratio, and I will explain what those mean. So let's start with the stock, and let me tell you what we mean when we're talking about the stock. So when it comes to stocks, actually, we're talking about the ownership of the company. So stocks are a type of securities in which the owners, which we call shareholders or stockholders, they have ownership over the assets of and profits of the company for sure. When you're buying a stock, as much as the number of shares you have, you are actually getting a portion of the company. So back to our first lesson, when we talk about accounting and finance, remember that assets in each company equals to liabilities and shareholders' equity. So when you talk about getting ownership of the company or becoming the owner of the company, remember not only you are becoming the owner of the assets, but also you are becoming the owner of the liabilities. Because we know the shareholders' equity is assets minus liabilities. So be careful with that when you talk about the ownership. It's not just the whole assets. It also represents that you are also in charge of the liabilities of the company. That's why actually when it comes to a dividend, when you receive the dividend when all the interests are paid, when all the expenses are paid. So at the bottom of the this transaction, that's the shareholders term. And for sure, there is a major difference between stocks and bonds. In the last module, we talked about bonds. Bonds represent the debt and the debt of a company. So either governments or corporation, they issue debt in the form of bonds. So the bondholders or the investors who are buying bonds, actually they have a claim on the company's assets in a way that they have priority to receive their interest, to receive their principal. So if the company is not able to pay back the interest or principal, in this case, actually the company is obliged to sell part of its assets to pay back to debt holders. However, shareholders is not the case anymore. For the shareholders, whatever is left after paying out all the interest and expenses will be for shareholders. If, for example, the company doesn't have or for some reason doesn't want to pay dividend, shareholders, they cannot claim to receive any money from the company. So you have to remember in terms of the priority of receiving money, your money from the company. When it comes to stocks, usually we're talking about common shares or common stocks. However, we have another form of stocks which are called preferred stocks. So preferred stock, they have a more hybrid nature of a stock and or securities. Why hybrid? Because they have some features which are very similar to debt or bonds, and they have some features which are similar to stocks. For example, similar to debt, preferred stocks, they have no voting rights. But if you have common shares, in this case, as many as, or I would say as much as the percentage of your shares you can vote. For example, if you own 10% of shares of a company, your voting right is as much as 10% of the total number of voting rights actually here. However, similar to common shares, the preferred shares, also they receive some sort of dividends. However, the dividends which preferred shareholders they receive, it's before paying to common shareholders. So we talk about the debt, and we mentioned they have priority over shares. Similar to debt, preferred shareholders they have priority in terms of receiving their dividends, and after paying out the dividends to preferred shareholders, if something is left, the common shareholders they can claim on the dividend in this case. Uh, we have several forms of preferred shares. In some preferred shares, the dividend payments are cumulative. Some of them are non-cumulative. Now, maybe say Ali, what those mean. So cumulative, it means if for some reasons the company is not able to pay dividend to its preferred shareholders, the money will be accumulated over time. So for example, I was supposed to receive $2 dividend per share for this year for as a preferred shareholder. The company doesn't have enough money, so if next year they have enough money, not only they need to pay my $2 dividend for the following year, they also need to pay me dividends for the current year. So that's the meaning of cumulative. So the money, the dividend payment is cumulative over time. Usually when it comes to preferred shares, there is another feature which is very similar to that is the payment. The dividend payment usually for preferred shareholders is fixed. It means, for example, they receive a fixed amount of dividend per share every year. Let's say I said $2. So that $2 doesn't grow over time. $2 this year, $2 next year, $2 the year after. So that's why the cash flow for preferred shareholders is something which we call perpetuity. We talk about perpetuity when we mention time value of money. I encourage you to go back to module 5 when we talk about time value of money and we talk about the perpetuity annuity. So the dividend which preferred shareholders they receive is very similar to the perpetuity because they expect to receive for many years, technically you can say for unlimited time, the same amount of money. So we talk about the primary markets and secondary markets before. Remember, when you're talking about the primary market, it means the companies are able to raise funds. So if the companies are selling their shares for the very first time or the subsequent raising funds, it's happening in primary markets. If it's happening for the very first time, it's called initial public offering or IPO. If the company is raising funds, it's already listed in the stock market, but it's raising additional funds from the market. This is happening in the market which we call seasoned equity offering or SEO. The both are happening through primary market. Again, the major difference between primary market and secondary market is in primary market, the companies are raising funds. In secondary market, such as NASDAQ, NYSE, TSX, in these markets, the already existed shares of the companies are traded. For example, I'm buying and selling shares of Apple. So I'm buying from another investor, I'm selling to another investor. So this is happening through secondary market. Why are these? The companies are not raising funds. There are some other advantages of being active in this market, such as reputation, such as liquidity. So that's why we have secondary markets. I promise I'm going to explain more about the market jargon. So let's talk about Apple's stock and see what we understand when we look at the information from the stock market for Apple. So here is a screenshot from the Apple shares. As you see, the ticker, this is called ticker, is AAPL for Apple. So if you go to Yahoo Finance, if you just enter AAPL, it brings you to the Apple shares. So this is the latest, the last price. As you see, this is the company is listed on NASDAQ. In NASDAQ, most of our IT companies are listed NASDAQ, such as Google, such as Microsoft, so they are listed there. So it's showing the price changes, that's the latest price. And the graph on the right side is showing you the historical price in a graph, nice graph, so you can see the trend up and down. So here it's upward. So during the March 2020, because of this kind of pandemic situation, the market has been down, the stock has been down, and since then there has been rally and recovery from the previous drop. Now, if you look at the left side, you will see there are some important information. So you see ask and bid on the left side. Ask, that's the price which is asked for the sellers. So if you're selling your stock, you can ask for a specific price. For example, here the asking price is 106.93. So you want to sell your stock at this price. The bid, that's the price which buyers are willing to pay. So the bid price is the price which the buyers are willing to pay. In this case, is 6 cents less, so 106.87, and it makes sense. Always the ask price is greater than the bid price. And that makes sense because you always want to sell higher. You're always to want to you are always want to sell higher, and you are always want to buy lower, and that's why the ask price is always greater than the bid price. And when the ask and bid are matched, for example, we agreed on the specific price, that's the time when the actual transaction will be executed. And for sure, this is happening through brokerage firms which we have in the market. And here it's showing the days range, so the lowest price, the highest price, and also the 52-week, almost a year range, the lowest, the highest price, and it's showing the variance of the price from the lowest to the highest. The volume of transaction, how many shares are traded on this specific date, what is the average volume. So you can compare the volume with the average volume. For example, on this specific day, you will see the volume has been much higher than the average volume. Usually when there is a news around, or maybe that's a very good price, you will see that the volume it's getting bigger and bigger, so more investors are interested to buy these stocks. The market cap, so which is another important thing, it's showing actually the total market value of the shares. How we calculate the market cap or the total market value of the shares, it is based on number of shares and a stock price. So if you multiply the number of outstanding shares which are available in the market to trade and that specific day's stock price, you will find the market cap. Again, market cap is showing total market value of the shares. For Apple, for that specific day, you can see the market cap is just over $1.8 trillion. So if you multiply again the number of shares by the current stock price, which is 106.84, you can find the market cap. Beta. Beta is a more complicated topic, and I will come back to beta later, and I will show and explain how to calculate beta. But for now, in a nutshell, it means that how volatile is your stock compared to the overall market. So if, for example, you say the overall market, I'm using S&P 500 as my reference point, as what the average market is doing, and here is your stock, which in our case is Apple. It's showing, beta indicates how volatile is your stock when the market is moving up or down. So for example, if the market is going up by 1%, how much your stock is going up or down. In our case, the beta for Apple is 1.28. Beta of 1, it indicates that the stock is moving the same as the market is moving. So if the market is going up by 10%, the stock is going up by 10%. But since this is over 1, it's 1.28, it means your stock is more volatile than the market. So if the market is going up, the stock is going up even further. If the market is going down, the stock also is going down even further. So it means you are talking about the riskier investment, the riskier stock compared to the market. Again, beta 1, it indicates the market volatility. Over 1, it's more volatile than the market. Less than 1, we are talking about less volatile than the market. Maybe you say, Al, is it possible to have 0 beta? And the answer is yes. Some of the government bonds, they have almost 0 beta. We call them risk-free assets or risk-free investment. In this case, the beta is 0. So price earnings ratio, it's showing the stock market price divided by the EPS of the company. The higher price earnings ratio indicates the high potential for the growth. So it's more expensive. However, investors, they expect the company is going to grow faster. Usually for IT companies such as Apple, you will see the higher price earnings ratio. For some companies like auto manufacturer companies, the banks, for some other corporation, you will see the pricing ratio is much lower, even below 10. EPS is earnings per share, the total net income divided by number of shares. It indicates the EPS of the companies. So TTM stands for trailing 12 months. So it's showing the historical data for the last 12 months. They calculated, it's showing the last 12 months earnings per share. So, and for sure, we have a forward-looking EPS, which in this case, it's based on the estimation of the experts. So here are the major parts. Just let me wrap up, talk about the dividend yield. Dividend yield, that's a good indicator of how much the company is paying dividend. If you divide the dividend of the company by the stock price, you can find the dividend yield as well. For example, in bracket here is showing for Apple, the dividend yield is 0.74%. It means just 0.74% of the price is reflected in dividend. In other words, the company is paying very low dividend compared to its price. So why is that? It's very common for the companies which are growing fast, such as Apple. They pay very low dividend. Why? Because they want just to reinvest all this money in the company, and they don't want just to give out to the shareholders. But if the growth rate is low, if the company is not able to use the money, they are just usually paying the higher dividend ratio. If you are looking for a constant fixed stream of cash flow, you should look for the companies which they have high dividend yield, or dividend to price is higher. So if you're just looking for high dividend paid companies, for sure Apple is not one of the choices. You have to look more kind of value stocks in which the dividend is higher. Apple classified as one of those growth stocks in which the price earnings ratio is high, the dividend yield is low. I hope you enjoyed this session. Next session, I will talk about different approaches for stock valuation. Till then, have a wonderful day and talk to you soon. Here is Ali Talabi. Take care.